Hi, my name is Francesco Fili. I'm CEO and CIO of Fasanara Capital. I'm here today to talk to you within the next few minutes about a top value opportunity that we see in European markets, given the current macroeconomic environment. We believe that one great opportunity is to be long optionality on Peripheral Europe at this point in the year. Within the next few minutes, I will contextualize the trade in the current market environment. I will identify the core catalyst to the view. I will describe you how we plan to play the theme, and then I will give you a specific time frame for the opportunity. Here we go. So the opportunity could read as follows. We think that there is a 40+% upside to be grabbed on selective Italian equities and Greek equities, especially in the banking industry sector. Italy and Greece in particular is where we see the most upside, given the view that we want to play. In terms of timing for our view, we think really the view will play out in 6 to 12 months, but there are chances that the bulk of the performance that we see is to materialize before year end. And the catalysts that we are thinking of are of three types. The first catalyst are represented by the ECB, having entered an active role in trying to engineer QE type policies and the TLTROs. The ECB is trying to battle against deflation. Deflation is just gripped European markets. We believe that the ECB is too late in the game, it's behind the curve, and therefore it won't be able to prevent inflation number from becoming negative, which means that the ECB itself not only has become active, but will have to be forced to step up its game from here. We expect the ECB to follow a three-steps process, and we will describe the process in a minute. The second catalyst that we see is the AQR and the asset quality review in European markets and the stress test to be carried out, the results of which will be available at the end of October, and preliminary results might be released also to banks by the end of September. So by the 22nd of September, it seems like. And we think that the AQR and the expectation of the AQR looming ahead has been a powerful cap on the performance of the banking sector in peripheral European markets up until now in the year. And as this fades away, that will unleash the upside on these markets quite dramatically. And finally, the third catalyst that we see is geopolitical events. We obviously know that, and we can all see that Russia and their standoff with the West over Ukraine has provided a headwind to upside in equity markets up until now this year. We think there are reasons to believe that the situations will de-escalate. It will come late, but it will come, and it will be an enduring solution for various reasons. But the basic line that we think of is that an escalation of tensions will bring up recessions in Europe, but might bring up a default event in Russia. Starting with the ECB, as I said, we expect the ECB to follow a three-steps process. First and foremost, the TLTROs will be implemented in various tranches over the next year from now, and the first one will be in September, the second one will be in December. We think that the chances are very high that the ECB will have to enhance the terms of already generous TLTROs instruments while stepping up the rhetoric over QE type policy down the road, right after TLTROs. The reason why we believe that the TLTROs will be even more generous than they are already is because a measure of their success is how much take-up is there in the TLTRO themselves. They're already very cheap, but there are ways to make them even cheaper. There are ways also to increase the quantity beyond the 7% cap that has currently been envisaged. In addition to this, the rhetoric over QE type policies and an ECB version of QE policies which might be functional in Europe is to be stepped up. It has already started in Jackson Hole at the end of August. It has continued at the ECB meeting in this month, and we believe that rhetoric will be stepped up from here quite dramatically. Second step that the ECB is going to follow, in our opinion, is to help a benign resolution to the AQR process itself. As I said, the AQR is going to be done and dusted in any case by the end of October, and we think that fears over the AQR process will dissipate because the capital needs for most banks in Europe, for most relevant banks in Europe, will be small and they will not entail any tail risk for the markets, and it will be easy for most banks to deal with them, for most relevant banks. And some banks have already capitalized themselves very healthily this year, and especially the banks that we consider in our trades in Italy and in Greece. And we believe that the AQR will prove to be a smooth process. If there was some uncertainty before, now that we live within this inflationary environment where inflation across Europe went all the way from 2.5% in 2012 to 0.3% today, and is flirting with the outright deflation, it's not as uncertain anymore, because it's in the interest, in the vested interest of the ECB to make sure that the AQR won't be destabilizing the markets too much and drive even further internal devaluation and deflation across European countries, and especially peripheral European countries. Then finally you have a fully fledged ECB version of QE itself. Draghi has already talked about ABS direct purchases. It's been rumored for up to $500 billion, for 500 billion euros. We tend to think that the tradable ABS securities are only 250 billion, and out of which the SMEs are a small portion of the overall amount, so that won't be enough. So what you have then is covered bonds, plugging the gap, and then you have something else. We believe that the ECB will be forced into sovereign QE as well, if they really are serious about, and they are, about stepping up their efforts, expanding the balance sheet by 1 trillion euros. Sovereign QEs are very important in our opinion, and they will be implemented together with covered bonds, ABS, and the rest, for the simple reason that the rates are too high in peripheral European countries. The third catalyst that we mentioned, in addition to the ECB and the AQR process, is Russia. As we said, we believe Russia may come back to the negotiation table, and within the next few months we will see a de-escalation of risk and this standoff between Russia and the West countries. It is true that Europe faces a recession risk if there is an escalation of the conflict. It's been estimated that Europe will knock off their GDP growth in 2015 at 0.5%, which means a recession, so it's a very dangerous risk, but the risk faced by Russia is much bigger because it's outright default and a replay of 1998. In terms of where we put our money on this trade, well, as I said, the two most interesting markets where we have the best local knowledge, but where we also identify the most upside potential, are Italy and Greece, for different reasons. Italy is a very big country within Europe, the third largest, and is very instrumental to the European project at large. It's facing very difficult times, slowdown in the reform agenda, but most importantly, very critical statistics on its debt and the metrics of debt ratios. It will be at 140% debt on GDP by year end, with a youth unemployment of in excess of 43%, industrial production having fallen off the cliff within the next 6 years by 26%, and GDP lower by almost 10% in absolute terms, back to the levels at which it was in year 2000. Within Italy, there are specifics that they render it particularly interesting. There are some stocks we have identified, especially in the banking industry, that they have a very high chance to go smoothly through the AQR process, because they have replenished their capital adequacy ratio incredibly well through issuance of rights offer on equity, but also tier 1 hybrid capital. And in addition to that, within the country itself, there is been discussion still dragging along on the repayment of government arrears. Italy has got to pay to its SMEs still 70 billion plus euros of government arrears. It is likely that will be engineered within the next 6 months, and that will equate to 4.5% of GDP. So it's a strong catalyst which might increase the appeal of the country itself, relatively speaking, within a very benign macro environment overall, as we have described before. From a valuation standpoint, Italy is still very, very cheap. It is trading at book value, and it is trading at 15% discounted to even Spain on a forward PE and a price on book value. Greece is a super interesting theme, again, to be played in optionality terms. We think Greek banks in particular, and some of them in particular, are the best and the most interesting they've been in more than 10 years. They've never been cheaper than they are today, not even during the Lehman crisis and the Greek sovereign crisis, and they've never been better capitalized and transparent about the true value of their assets in many, many years. As I said, their stock fell more than they did during the Lehman moment or the Greek sovereign crisis in 2010-2011 for various reasons. Not only the expectations of the AQR ahead of us looming and the potential need for some capital replenishment on the side of the Greek banks, which is already priced in the markets, which we think might be there, but might be very marginal, very negligible. Because these banks have already done a lot. They've raised more than $11 billion this year alone, and they've done great progress in terms of increasing their loan loss provisions, their coverage on NPLs, etc. We think there will be something coming out of the AQR at the end of October, but it won't damage them too much. If anything, it's going to unleash the huge potential on some of these names which are so depressed in terms of prices. They've not been favored by the news string in the last few months. There has been the jump to default of Banco Espirito Santo just 1 month after doing a capital increase, which has taken the markets on the back foot and clearly has created a lot of trouble for similar markets to Portugal like Greece and created a lot of bad opinion about some of these banks. And we think that is an isolated case. We think that with the AQR done and dusted, that fears will fade away. The ECB will have put their approval on their balance sheet, and right after we will be able to see these banks and some of these banks which are trading at a fraction of their book value, tangible book value, be able to increase from here. As I said, we expect the Greek banks to be small to no need of capital after AQR, at least the Greek banks that we are currently looking at. For both Italy and Greece, we look at a variety of different instruments. I won't be able to be too specific here, not to disclose exactly the type of positioning that we are doing at the fund level, but what I can say is that most of our positions will be in optional format, giving a very asymmetric profile. It's a combination between the favor that we get in having a very low level of implied vol, historically low levels of implied vol, which is not only related to Italy and Greece alone, but it is also related to Italy and Greece, which are trading at a fraction of their historical volatility, at a fraction of their realized volatility, etc., etc. The market also allows for the availability of some instruments which are option-like, which are traded and liquid in the markets, and that is what we have been on our main flagship fund amassing over the course of the last few months, and where we see also an opportunity for this specific trade to be done now in expectation of the AQR. The timing is imminent, as I said. We want to be positioned by the end of this month and as early as possible into early October, because the three catalysts will have, most of them could have played by the end of October.